You're listening to the WBT Podcast with Micah Lodge. Listen to all of our podcasts at www.wbtpod.com. Stay informed. Let's get started.
About the end of the year, a lot of people come and ask us, what should we do in our W-4s? How do we affect our W-2s? But the issue that I'm seeing lately is that a lot of people don't even know how to read their payroll stub. They don't know how to figure what's happening on their payroll. So I think it would be a good idea this morning to kind of go over what you need to look at and how to understand your payroll stub. And then we'll talk about the W-4 later on. But the first thing that you need to do is look at your payroll stub, get your payroll stub, and then look at your gross pay. Gross pay means that no deductions have been taken out as of yet. So depending on the work you do and how you're compensated, the money you earn may be described either as a salary or wages, commissions, bonuses, tips, and other income, or something else altogether. This is also where you would also see where your vacation, sick, holiday, and other forms of compensation are listed. This is your gross pay before any deductions are made from your paycheck. Start at this point to make sure that your employer is paying you correctly based on how you are paid, such as hours worked, times, hourly rates, the portion of your salary you are owed for any pay period, any bonuses, commissions, or tips owed, and so on. Once you've made sure that this gross pay amount is correct, then you can kind of make sense of all of the deductions that come after that. Now, just remember that a payroll period is, in accounting terms, 4.33 weeks per month. Okay, 4.33. So if you want to know how to calculate all the hours that you should have been paid, you have to do it by 4.33 or divide that in half so that you get your biweekly hours that you should have been paid for, and on top of any overtime and everything else. So now let's look at the payroll deductions. Okay, there are a number of things that can be deducted from your gross pay, but they mainly fall into two groups: before tax and after tax. Remember those two words, before tax and after tax. What difference does it make, you may ask yourself? Well, in short, before tax deductions will reduce your taxable income, meaning you'll pay less in taxes. Here are some of the most common before tax deductions that you need to look at and understand. You may see them on your pay stub. Retirement plan contributions, health insurance premiums, dental plan premiums, vision care premiums, life insurance premiums, health savings account contributions, flexible health or child care spending account contributions. So since the federal government allows people to deduct these items from taxable income, your employer can make things a little easier and subtract these items from your pay, and then use the remainder, your taxable income, to determine how much tax to withhold. Okay, so these are other items that don't qualify for pre-tax deductions, called appropriately after-tax deductions. These can include contributions to a Roth 401k, child support payments, retirement plan, loan payments, or other types of issues like that. These things still come out of your pay, but they won't lower your taxable income. Okay, so I think that's good that you understand that. So what are all of the different kinds of taxes, and how do they affect your paycheck? And I know that when you look at your pay stub, you see all these taxes and you say, oh my gosh, I don't even want to look at that. But I want you to understand it. Taxes includes federal, state, and local income taxes, and also the Medicare and Social Security tax, which may be called FICA. So if you see FICA, that's your Social Security part, or payroll tax on your pay stub. You'll see those. First, federal income taxes. How much is deducted from your pay is determined based on several things. Your year-to-date income and federal income taxes deducted. Your income in the pay period, W allowances, withholding allowances, and additional withholdings you selected when you filled out Form IRS Form W-4. And I encourage each of you, right now would be a good time to look at your total income, sit down with your tax accountant prior to you going in and seeing whether or not if you need to take additional taxes out. And the only way you can do that is by filling out W-4 and changing your exemptions. So if you haven't done that, do it now. Take a look at it. Be proactive on this so that at the end of the year, you're not owing a great amount of taxes. Excuse me. So how much you earn is the biggest driver behind how much federal tax your employer withholds each pay period. So, but in improperly filled out W-4 can also have major consequences. Since this form W-4 tells your employer how much to withhold. Remember, the employer just doesn't withhold taxes, but you tell them how much to withhold based on your W-4, okay? And it's based upon the number of allowances, your spouse, dependents, and other child care related items you claim. The short version of this, claim too many allowances and your paycheck might be bigger, but at the end of the year you'll end up writing a check to the Internal Revenue Service on April 15th. That's never a good experience. That W-4 is a vital document that tells your employer how much to deduct. And if you take too little out, you'll end up owing on April 15th. Claim too few allowances and more of your check will be withheld for federal taxes than you owe. And then you'll get that money back when you file your tax return. Filling out the Form W-4 is always confusing, I know. But filling out the form accurately will help to ensure your employer withholds the appropriate amount from your paycheck based on your income independence. It also is important to update your W-4 if you have a major life change, such as a birth of a child, you get married or divorced, or experience some other change to your tax status. When it comes to Social Security and Medicare tax, it's pretty simple. So here's the 2017 rate. Social Security is 6.2% of the first $127,200 in earned income. Medicare is 1.45% of all income, plus an additional 0.9% for earnings above $200,000 for single filers. The extra 0.9% is applied to income above $125,000 for married separate filers and $250,000 for joint filers. State and local taxes can vary greatly from one place to the next, so it's best to check with your state or city tax or revenue website for specifics where you live. But I want to stress this very carefully. If you've had a life-changing tax situation or a change in your life, it's going to change your tax situation. If you're going through a divorce, it's going to change it. If you had a child born, it's going to change it. So, and right now at the end of the year, a lot of you may have claimed more exemptions and may owe taxes at the end of the year. So you need to sit down or call your tax practitioner and go over what you've done and see if you don't need to make a change in November and December so that you can be in compliance with the amount of taxes that actually should have been taken out. That's up to you. It's not up to your employer. Your employer does not know your situation at all. Okay? In fact, a lot of times they don't know how big your family is. They don't know anything that has happened to you during the course of a year. You need to tell them through that W-4 how much taxes you're taking out. Now, those of you who have filed tax exempt, okay, I get so upset with you every single year when you come into the office and on your W-2, you've had no taxes taken out and you're wondering why you owe at the end of the year. There are only certain circumstances that you can do tax exempt. And let me tell you, there are legal consequences if you did not pay taxes when you should have. There are only certain circumstances where you file tax exempt. If you fall out of that circumstance, it could be a criminal action. So I want you who have filed tax exempt to think about that very carefully, because if you owe taxes at the end of the year and you blame your tax accountant, shame on you. Shame on you. So let's get to the bottom line of your stub, okay? Of your payroll stub. And what you can do to stretch that number. Now that you have a better idea of how everything gets deducted down and what's being put into your gross income and what's being taken out, you should be able to better understand how your employer got to that net pay. Remember, gross minus expenses equals net, okay? So now you understand how you got to that net pay number that shows up on your paycheck, okay? The amount that's going into your bank account. You should also think about doing a few things to make your money grow further too. The first place to start is with your W-4. It's important to make sure that you are claiming the proper number of allowances to get the most bang for your buck, as they like to call it. It may be nice putting few allowances, taking a smaller check, getting a big tax refund, but it's actually pretty inefficient way to manage your money. A smarter thing to do would be to claim the right number of allowances and contribute more money to a savings or towards paying off credit card or other debt every pay period. And then another smart move would be to increase the contributions to pre-tax benefits, especially things like a 401k plan or a health spending account that will almost certainly, that you will need at some point in time. You just will. If you're in the 25% tax bracket for 2018, the median American household will be, you'll cut your income taxes by $250 for every $1,000 contributed to a 401k plan, flexible spending account, or other pre-tax benefit program you may not certainly take advantage of. You need to take advantage of that. That's basically a fee of $25 from the government for every $100 of your own money that you've contributed. Okay? So I want you to really think about your payroll stub. I also want you to really focus on the W-4, and you may need to change it within the next two months. In fact, it's almost now a month and a half. We're getting very close to that halftime of November. So you don't have much time. So I would strongly suggest that you sit down with your tax practitioner, or give him a phone call or her a phone call, and go over what you've done on your W-4. He knows already, or she knows already, what you've done in the past, if you own a home or all the other stuff. So that's already in their system. All that you need to provide them is what you've done thus far, and kind of estimate what you're going to do for the remainder of the year. So I tell you, this is vital because so many clients come into the office and they have not thought the year through. They were not proactive. So when they sit down and all of a sudden they owe money, It's always the tax accountant's fault. It's never their fault. But it is your fault if you have not managed your W-4 and how many dependents that you, or exemptions that you're taking on your W-4. Remember, your tax thing changes. And that also is with ACA. If you're participating in the ACA, and if anything has changed in your ACA, you needed to tell ACA of that change. Otherwise, you may be hit with a fine or penalty because you did not notify them of that change, of how it's going to change your insurance program through the exchange. And a lot of you know this already because you've already been hit with $800 and some, I've even seen it go up to $8,000 that they owe because of the wrong reporting to their exchange. So right now, focus right now. Go to your tax practitioner, sit down, revise your W-4, because remember, your employer is just deducting what you tell them to deduct based on that W-4. So it comes down not to your employer, not to your tax accountant. It comes down to you telling your employer what you want deducted. If you have any questions, just send me an email at mlodge@lodge-co.com, and I'll try and help you through this. But I want you to understand you don't have much time. You only have a month and a half to really look at the end of your tax situation in your life. So get to it. This is Mike Lodge, and I will talk with you soon.
This is brought to you by Lodge & Co., a business and tax advisory firm where your success is our goal. Call us today toll-free at 888-681-1518 or visit us at www.lodge-co.com and learn more about what we can do for you. Lodge & Co., your source for sound business and tax services.
Thank you for listening to the WBT with Michael Lodge. Join us again tomorrow as we explore more about business and taxes. Follow us on iHeartRadio and go to our podcast website at www.wbtpod.com and listen to all of our podcasts and read our blogs.